Recently, I hit $100,000 in my Robinhood investing portfolio. In this video, I really just want to go over all the details, or really just 5 lessons I would say that I learned from going from $0 all the way up to $100,000. What could have I done differently? Could it happen faster? All those different things. So we're going to talk about that, just a conversation. We're going to talk about that in today's video. Let's not waste any time. Let's jump right into it. Let's go. Take a look at my portfolio right now. We're sitting at $107,718.88. I'm recording this on a Sunday. The market is closed, but crypto is still moving on up, which is great. Either way, let's talk about the first lesson that I learned. And the first lesson I would say is less is more. When I first started investing, and especially investing into individual stocks, I truly believe that, well, I want to be able to buy this, buy that, pick this up, get a good price on this, and I'll be good to go. In that particular situation, I ended up buying a ton of different stocks. I think at one point in time, my portfolio had over 50 different stocks on it, but I only had about $4,000 to $5,000 in my account. So that means my $4,000 to $5,000 was split across 50 different stocks, and pretty much I wasn't going to make any money that way. You want to make sure you have a focused portfolio. You want to make sure you have a couple of stocks, maybe at most I would say 10, especially with a little bit amount of money. I think 10 is a lot. So I would say if you're starting out with a couple $1,000s, I would say 1 to 3 stocks. And if you have $10,000 or more, then I would say you can, obviously up the amount of stocks that you want to invest into. But the point is, if I invested into all 50 of those stocks with the $4,000 that I had, pretty much not going to make any money off of them, even if one goes up tremendously, simply because I might only have a couple of shares, maybe $100 or $200 worth of that particular stock. Either way, if we check now, I have about 16 to 17 positions open right now on $107,000. So that's not too bad. I am trying to still slim the portfolio down to under 10 particular stocks. But we haven't just got there yet. Nonetheless, less is more. You want to make sure you're focused on a couple of stocks so you can make the most money possible when it comes to one of those stocks or multiple going up. The second lesson I want to mention is age and risk really go hand in hand. So when it comes to age and risk, I'm literally talking about your age and pretty much how much risk tolerance you have at your age. For me, I started investing when I was about 21, and I started heavily investing into my Robinhood portfolio around the age of 23. At the age of 23, I'm not retiring anytime soon. I don't have a particular plan for this money in my portfolio right this very moment, but I knew I could take a lot of risk with my money. So it's no point in not going out of my way to take some risk with some bigger bets when it comes to the stock market. In the beginning, I was personally trying to invest into a whole bunch of different dividend stocks because I thought that was probably one of the best ways to get some passive income when it comes to investing in the stock market, which by all means is 100% true. However, a lot of dividend companies simply don't grow that much in value. They're not growth stocks, they're dividend stocks. So typically with dividend stocks, they might go up a little bit in value over the course of a couple of years, but nothing like a Robinhood stock or a Tesla stock or Google or Apple. They're probably going to grow a lot more, and you'll make a lot more off the growth than you ever will off the dividend if the company even pays a dividend. Of course, with more risk comes more downside potential, but obviously it's more upside potential. So right now, if you check my portfolio, year to date, I'm up about 19%. The market average year to date is only up about 7 or 8%. So that's pretty good for my sake. And obviously, the people that invest into just the overall market, that's fine as well. But I can make a lot more by investing into these risk assets with the chance of making even more money. And this could have been a lot higher if I changed my portfolio a little bit sooner. Now, as I get up in age, the best thing to do is to transition the portfolio from more risk to less risk to less risk to no risk when I get towards the point of retirement. At that point, it doesn't really matter. I have all the money I made from all the risks that I've taken in my previous years, and now I'm good to go to retire and pretty much don't have to worry about anything. I can invest into some safe bonds where things pretty much won't move that much. I won't make much money, but I won't really lose anything either. And I've already made all the gains over the last 40 years, you could say, so it works out. So the play here is just to take risks because you are young. As you get older, take less risk. The third lesson I want to mention is talking about having a portfolio backbone. If you don't know what a portfolio backbone is, you don't personally need it, but I just like to have it. In this particular case, pretty much you're investing into the overall market, or maybe a overall really big fund that you like for the market that tracks to the market pretty closely, and it's just like the overall thing that you want your portfolio to be without investing into individual stocks. So let me give you an example. If we scroll down here, I have ticker symbol DGRO, and I have about 255 shares. This is a massive part of my portfolio. As you can see right now, it's worth about $17,000, and I'm overall up about 23%. This portfolio, or this particular stock actually, is an ETF. An ETF stands for an exchange traded fund. So pretty much it's a whole bunch of different stocks put into one single stock that you can invest into, so you don't have to invest into 20 different stocks that do the same thing, right? In DGRO's case, it's focused on growth stocks that happen to pay a dividend. If we scroll down a little bit, we can see what some of those stocks might be, or pretty much their top 10 holdings. So right now you can see they have about 3% in Apple, Microsoft, Home Depot's a big investment for them, Procter and Gamble, Johnson & Johnson, and JP Morgan Chase. These are all growth stocks that do pretty well on their own that you can make money from, but they also do pay a very small dividend. Nothing like some other stocks that may pay a 6 or 7 or 8% dividend, such as like Verizon stock, maybe AT&T at one point in time, or Main Street Capital, you could say. Either way, those companies pay a higher dividend, so you're going to make more cash every time they pay out that dividend, but the stock price itself may not increase at all over a course of 5, 10, 15, or even 20 years. In this particular case, we're focused on stocks that will increase in value, most likely over a course of 5, 10, 15, or 20 years, and they're going to pay you a dividend as well. Not a massive dividend, but still some extra change in your pocket if you want to actually cash out on those dividends, or you can have those dividends be reinvested back into that same company. All in all, I decided to make DGRO my portfolio backbone. Pretty much the majority of my money that I invest would go into this particular fund, and this will be the focus of how I would invest in my portfolio. So I'm invested into a lot of growth stocks, and I'm also investing into a lot of growth stocks that pay a dividend. I'm doing both. And that's really my focus going forward, at least for the next 5 to 10 years. If you want a fund to invest into that's going to track the entire market, the most popular one is ticker symbol VOO, and that stands for the Vanguard S&P 500 ETF. This is going to track the top 500 companies in the US right now. You can have these be your portfolio backbones and still invest into those individual stocks if you choose to do so. Or you could just buy this and call it a day. Completely up to you. The fourth lesson I learned revolves around consistency and discipline. When it comes to consistency, I'm talking about consistently investing into the stock market. So you can do this a couple of ways. My two particular favorite ways are just simply doing this when I get paid. So every 2 weeks or every month when I get paid, I'll put some money that I have extra left over into the stock market. Or you can do it a different way where you wouldn't forget, and that's pretty much setting up recurring investments. So on the Robinhood platform, if I go ahead and type in recurring, I'm going to show you my recurring investments. Right here, you can see all my recurring investments that I pretty much invest into on a weekly, daily, or monthly basis. So as you can see, ticker symbol DGRO, it has a weekly buy set for $30. So that means every single week, no matter what happens, DGRO or $30 is going to come out of my bank account or out of my buying power on the Robinhood app and go into this particular stock. The same thing is going to happen for JP Morgan Chase, $5 every single week. SoFi, $10 every single week. Tesla, $10 every single week. Microsoft, you get the point. Google, Welltower, AMD, Apple, it's all there. Point is, you can set something up like this so you pretty much set it and forget it. That's what people do. You set it and forget it. You don't have to worry about it. As long as you got the money in your account, you're good to go. And if you don't have the money, then by all means, Robinhood will let you know. They'll send a notification, say, hey, we tried to pretty much invest the money, but it's not in the account. So do you want to pause or use a different funding source? Completely up to you. This way I know for sure I'm investing into the companies that I want to be invested into at every given time or every given opportunity I have to without even thinking about it, because it does it automatically for me. Now that we got the consistency down, you got to make sure you have the discipline. And the discipline, what am I talking about? I'm talking about having your own strategy and sticking to your own strategy. If you want to get in a stock, right? Let's look at, I don't know, this is a popular stock right now, SoFi. If you bought SoFi, let's say around $7 or $8 a share, because it was down there for a while, and you wanted to get out of SoFi, your original plan was to get out of SoFi around $25 a share, which is where it's at right now, then by all means, sell SoFi. That was your plan. Stick to your plan and sell SoFi. You don't have to sell all of your shares, but you want to make sure you have your plan. You want to make sure you make your money from it, because there's no point in holding on to a stock forever with the sake of not making any real money off of it because you did not sell. If your plan is to get in and out of a stock and day trade it, then stick to that. If your plan is to buy and hold for 5 to 10 years, then stick to that. The only time you should really be changing your plan is if something massive changes with the company. Maybe they have a new CEO, maybe the earnings reports are bad for the last 3 quarters. Anything could really go wrong, but if something's just going wrong in the world and not really against your particular investment, then don't worry too much about it. We have interest rates to worry about right now. So of course, a lot of people are talking about interest rates dropping over the next couple of months. I think the Federal Reserve is supposed to drop interest rates, hopefully, September 17th. So we'll see if that happens. But if it doesn't happen, if interest rates don't drop, the market will crash. Don't know how much it's going to crash by. It could be a couple percent or it could be 10%. I have no idea. That's the future and we're not there yet. The reason I mention that is because that's more of a outlying force. You can't really control what's going to happen with interest rates. You can only follow the stock that you're particularly invested into. Now, the interest rates would impact a company like SoFi, but might not impact another company like Google. But both of those stocks could drop just based on the bad news of the interest rates staying the same. You see what I'm saying? So don't let all these outside forces control your investment. Find your investment, figure out what company you want to be invested into, and if you think it's a good bet over the next 5 to 10 years, 3 to 5 years, whatever your timeline is, then stick to it and just make sure you're focused on what you're actually invested into. Follow the news on that particular company and you'll be good to go. All right, and finally, the last thing I want to mention, I kind of segued into, but it is timing. So timing is really important, but not important at the same time. Of course, you can get into the market at a perfect time. When I first started investing, I got into the market right during the COVID crash. So I picked up a whole bunch of different great stocks for a super cheap price. And honestly, if you bought any stock around March or April of 2020, and you wrote it out to the end of the year, you would have made money. It didn't really matter what you bought, but you would have made money. But you could get in at a poor time and you have to see it down. But that's why it's so important to focus on your particular investments. If you know your investment is a great investment at $100, then it's an even better investment at $80 a share, because that means you can buy more shares for a discount. If that's something you're into, if that's the investment that you want to make, then it shouldn't be an issue for you to buy more shares when it's $20 cheaper than what you paid for a couple of weeks ago. If that's not the case, then you might have made a bad investment and you might have rushed into what you did. So timing truly is not important when you have that long-term outlook. If you have a day trading outlook, then timing is very important, because if you miss out on an opportunity, then you could lose a lot of money. And if you make an opportunity, then you can make a lot of money. It goes both ways. But I can literally use the past week as an example. The market dropped quite a bit. I believe, what was this? August 20th. Our market was down, or at least my portfolio was down about $4,000 over the course of a day and a half. Really about one particular day. So market dropped, and you can see I'm down from 107 all the way down to $103,000, almost $102,000. I could have sat here and been like, oh dang, that's crazy. I'm gonna end up selling because it could keep going down. I don't know. I'm gonna just sell my shares now so I can get out and have the cash. But if I did that, then as you can see, over the next couple of days, when the more interest rate news came out, the market fully recovered within about 30 minutes. I believe, let's see, 9 a.m., 104, 11 a.m. on the same day, 107. So the market fully recovered just based off of news that I had no control over at all. So we're not going to focus on timing when it comes to a long-term outlook. And when in doubt, as people always say, when in doubt, zoom out. So if I go out to the past 1 month, we're still up. 3 months, we're still up. Year to date, we're still up. 1 year, we're still up. All time, we are still up. So even if it dropped down to a point like this, which it did, I still did not sell any shares. I ended up just buying more. Now, your particular case may be different, because you may need this money to do something with. Maybe you want to invest into the stock market to save money to buy a house, or a car, or whatever you decide to do. But for me, this is a great opportunity to buy more. Something like this, where it fully recovered within another year, which is fully recovered and extended even further than it was before, which is obviously great for me as a long-term investor. So when in doubt, zoom out. You'll be okay, as long as you're picking the right investments for yourself. And you can only figure that out because you're going to find out what you want to be invested into. Now, I have tons of videos on the channel talking about some great investments that you can make, but this is for entertainment purposes only, and you should do your own research. Nonetheless, if you want to learn how to invest into the stock market using the Robinhood app in particular, then I have tons of videos already linked on the channel. That'll be right up there, but you can check over the past month and this coming month to see tons of different Robinhood content that I've already posted. If you're interested in just learning the basics of the platform, I made a video for that, as well as a free ebook. I made a video for Robinhood options as well as a free ebook. I'm going to be making a future video talking about just generally investing into the stock market, as well as with an ebook for that, all taken care of for you. And that's pretty much that. I also made a video talking about 2 stocks that I feel like are pretty undervalued that you can pick up. The link will be right up there for that. I'm making a future video for it as well. So tons of stock content consistently coming to the channel. So make sure you like this video, subscribe to see more content like it, and that's pretty much it. So check those videos out. Download the free ebooks and links in the description. Go ahead and sign up and get started with your investment portfolio today. You'll get a free stock when you invest with my link down below for Robinhood. And lastly, grab my Greece wallpaper pack. You're going to get $5 off with my code down in the description. And pretty much these are some pictures that I took on my trip to Greece. curated just for you, for your wallpaper, for either your desktop, maybe for your phone, completely up to you, but I think it's pretty nice, so check it out. You get $5 off with the code down below, and that's pretty much it. I'll catch you guys in the next video. We're talking about SCHD in the next one, so if you're interested in that, or if you're invested into SCHD, then you may like it, you may not, but we'll find out when we drop the video in a couple of days. I'll catch you in the next one. I'm out. Take care of yourselves. Stay safe, stay positive, and stay hydrated. Dollar Mike. Peace.